In Chapter 15, we looked at the tools and institutions of monetary policy, particularly the Federal Reserve System. Here in Chapter 17, we take a look at the federal budget and the tools and institutions of fiscal policy, right? Which is the spending that government does and the taxation, the revenue raising that government does, and how we hope that will affect the macroeconomy. We'll see really more in Chapter 18 about that latter question. So what I really want to cover here in this video on Chapter 17 is sort of four things. We'll talk a little bit about taxes and sort of which taxes matter and why, where government revenues come from. We'll talk some about spending, about where spending takes place and what the major sources of spending are. We'll talk a little bit about government waste, and then we'll talk a little bit about the kinds of government activity that isn't necessarily measured in spending and taxation and the sort of traditional fiscal policy indicators. So let's start by talking about taxes. In many ways, those are the most important. The two biggest sources of government revenue are the individual income tax and Social Security and Medicare, what we call payroll taxes. If you work for a living, you know when you get that paycheck, you lose that money to that guy called FICA. That's Social Security and also the Medicare tax as well. And one of the things to think about here is that since the 1950s, government spending in the United States has been pretty consistently about 20% of GDP, while government revenues have been about 18% of GDP. So as we think about this whole taxation and spending thing, keep that in mind. As you can tell from that, right? If spending is a bigger portion of GDP than revenues, governments have been running what we call budget deficits, right, for that whole period. And again, we'll sort of talk about that more in just a minute, with a few exceptions, few years exceptions, but certainly over the course of the period since the 1950s, annual budget deficits, spending more than federal government takes in has been the norm. So where does the income come from? As we said, the major source of income, individual income tax and payroll taxes. One of the things to keep in mind about the Social Security tax, the payroll tax, is that the way FICA works is it's a 6.2% tax on your wages, and then 6.2% is paid by the employer. And you might be tempted to think, well, okay, so my employer is paying for that other 6.2%, but not really. One of the most important questions we talk about in economics, and because this is a macro class, we're not going to get into it in any great detail, but if you've taken 201, or when you do take 201, certainly if you take intermediate level micro, we talk about the burden of taxation. The question isn't who the tax is sort of legally placed upon, rather economically, who pays the tax. And just because, for example, a gas station has to actually write the check for the taxes it collects on gasoline, doesn't mean it's paying those taxes. You and I, it turns out, pay most of those taxes through a higher price for gasoline. We're just not the ones who write the check. So the burden of taxation here is really important. Who actually pays matters. And it turns out with those payroll taxes, it's you and I, it's employees who pay. Employers have to pay that 6.2%. So how do they do it? They reduce your wages from what they otherwise would have been so they can afford to do that. Were that Social Security tax not in place, not only would you have back the 6.2% that you pay directly, you'd have a good hunk of the 6.2 that they pay for you would come back in the form of higher wages. If they have to bear that cost of paying that tax, they're going to take it out of somewhere. Comes out mostly out of our wages. So burden of the tax is important. That same question is important when we talk about another source of revenue, which is the corporate income tax. In the United States, corporate income tax is about 35%. It's one of the highest in the world. There are a number of other countries that have no corporate income tax whatsoever. And it's easy to think, oh, corporate income tax, we're taxing corporations. Corporations pay that tax, not people. Well, no. In some sense, there's no such thing as corporations. They're a legal entity that we create, economic and legal entity. In the end, only individuals pay taxes. And that 35% tax that corporations pay on their income, ultimately the burden of that is paid by individuals, the shareholders and the bondholders of the corporations, mostly, who see lower rates of return on their investment than they would otherwise because of those high rates of taxation. But it can affect employees as well, too. This is the important point, right, though. Only individuals pay taxes. Corporations don't pay taxes. Households, in some sense, don't pay taxes, right? Only individuals pay taxes. So when people say, oh, we can fund that by raising the corporate income tax, that way we're taxing corporations. Well, yeah, but you're taxing people, right? The people who own and work in those corporations. One other issue to think about with taxation is there's a couple of charts, tables in this chapter that look at who pays which share of taxation. In particular, slide 21 has these two, the distribution of federal taxes. And one of the things you can see from there is that the top 20%, the top 1% of earners pay the vast majority of federal income taxes, right? And in fact, that the bottom 20% and second, sort of lower middle class, second to bottom 20% pay almost a very tiny share of the total federal income tax. So one thing to think about is people talk about whether or not the tax system is fair. What would constitute fair? There's lots of answers to this question. Let me pose one and sort of just get you to think about this question. One notion of fair would be that the proportion of total taxes that people pay is roughly equal to the proportion of total income that they earn. So if the top 20% of earners, right, for example, earn 60% of all income, then they should pay 60% of all taxes. If the middle 20% earn 25% of all income, then they should pay 25% of all taxes. Again, I'm making those numbers up, but that would be one notion of fair, right? Is that the proportion of total taxes you pay is roughly equal to, or similar to, the proportion of total income you earn. If you look at the United States today, you'll find that that is not the case at all. In fact, it turns out that lower income earners pay much less in their total share of taxation is much less than their total share of earnings. And for higher income earners, they pay a great deal more in terms of their proportional share of taxation than their proportional share of earning. This is not, by the way, what the book means by progressive, but it's related, right? And it's interesting, for me, an interesting question of fairness. When we say the rich don't pay enough in taxes, or it's not fair how little they pay in taxes. Well, what do we mean by that, right? I mean, if you are earning, if your income group earns 30% of total income and you pay 45% of total taxes, that might be good or bad, but it's perhaps difficult to see why that's unfair, right? You're paying a higher percentage of total taxes than you're earning in income. Again, that's just one definition of fair, and I think it's worth thinking about here what we would like a fair taxation system to look like, and when we say it's not fair, what exactly do we mean by that? So that's the taxation side. On the spending side, there's not a whole lot to say here. As the book points out, 2/3 of the federal budget is made up by 4 items: Social Security, Defense, Medicare, which is medical expenditures, government covering medical expenditures for people over 65, and Medicaid, which is government spending on medical care for people who cannot afford it, for the poor. So Social Security, Defense, Medicare, Medicaid. A couple comments about all of those. Social Security, as the book points out, is getting more and more difficult to fund. When it was originally funded, there were lots of earners for every person who was receiving Social Security funds. At one point, I think early on, it was something like 7 to 1. Now that's down to 2 or 3 to 1. That is, changes in demographics and so forth mean that there are many fewer people paying into the system to support the transfer of funds to those who are receiving Social Security. Also important to remember, again, when you pay into Social Security, that money doesn't go into a box with your name on it where it sits until you retire. Those funds are used to immediately pay out to those who are getting checks today. There isn't, I mean, there isn't this box that has all this sort of accumulated Social Security in it. There's some sort of IOUs and all this all over the place, but current Social Security revenues are largely paid out to current Social Security recipients. On the defense side, again, this is a debate sort of beyond the scope of this class, certainly, but it's worth asking. We have one of the largest defense budgets in the world, and whether or not that's appropriate and whether or not that's a good use of our resources is always a question worth asking. Do we need to be spending as much on defense as we do? Medicare, Medicaid, much more complicated. Certainly those expenditures have gone up a great deal in recent years, both as the population's age, but also because of changes during the Bush administration and Medicaid Part C and some other kinds of things. Whether that's reformable is a good question, and we hear now talk from political candidates of Medicare for all. What exactly does that mean? And in a time when the current budget deficit is about $1 trillion, can we afford to do that? All really good questions. The other thing I want to make sure we understand is the difference between between the budget deficit and the total debt. The budget deficit refers to the annual amount that government is either the difference between annual government spending and revenues. So, as is the case in most years, government spends more than it takes in. We have a budget deficit. In current year 2019, that's projected to be over $1 trillion. In fact, here we are in September, October, we're already pretty much at $1 trillion. So that's the annual deficit, which is how much we spend more than we take in taxes. There have been a few years where we've had a budget surplus, where we have more in revenues than in spending. There were a couple of years during the Clinton administration in the late 90s, one back in the 60s as well. But for the most part, since the 50s, since World War II, we have consistently and persistently run budget deficits. There's some reasons for that. We'll talk about that actually next week in our chapter on political economy. But for now, I just want to make sure we understand what the deficit refers to, which is, again, the difference between federal government revenues and federal government spending, and that it's that annual number. The national debt, on the other hand, is the accumulation of all those deficits over the years, plus whatever payments on the debt are made. That number now, the total debt's around 23 trillion. That's the total outstanding debt and the accumulation of all the deficits over the years. As the book points out, that's the total debt, a good hunk of that debt. Some of that debt's held by the federal government and agencies and so on. The number we might want to pay more attention to is the amount of the debt held by the public. A couple of years ago, that was 14 trillion. That is now, I think, closer to about 16 trillion. So that's still a pretty large number. It's as the book points out, as a percentage of GDP, it's about held by the public. It's about 70% of GDP. Is that a problem? It's not good, but it's not a crisis either. One of the things we worry about with government spending is when we have this enormous debt, we pay interest on it, right? The federal government pays interest on that debt. That is also one of the larger items in the government's budget, is the interest it pays on the debt. And if interest rates start to rise and government has to pay higher interest rates on that debt, that number could become a significant part of spending and could drive spending up even further. One last point about the deficit and the debt. It's tempting to want to say, well, look, the burden of the debt and the deficit are pushed off on the future, right? Someone else has to pay that off down the road. We're borrowing it now, right? So it's not our problem now. Well, in fact, it is our problem now. And in a meaningful sense, the burden of that debt is on us now. The resources that we divert away from other uses to pay interest on the current debt, to pay for the things we use that we spend on right now, all of that constitutes a burden of the debt on us today, right? There certainly will be a burden on you guys and on your children and on your grandchildren. That's really important and worth thinking about. But it doesn't mean all of it is on you. Some of it, a lot of it maybe is on you, but some of it is on us. One last point to consider: if you're someone who is concerned about what we might call the intergenerational justice and injustice of global climate change, that is, one of your concerns is how are the decisions we're making with respect to global warming and climate change today going to affect the next generation of children, the generation of children after that. If that's something you're concerned about, you should be also at least as concerned about the total national debt and the ongoing deficit. The burden of that is significant for future generations as well. And if you think it's wrong for people today to put an environmental burden on children in the future, you should also think it's wrong for people today to put an economic burden on people in the future. So again, if you think that the future costs of global warming are a real problem, it's unjust to put that burden on future generations, you might want to think about the deficit and debt in the same way. Two last points here. One, if you think you can solve these problems of deficits and debt by cutting government waste, that's probably a fantasy. There's certainly plenty of government waste to cut, no question about it. Government wastes resources all the time. But two things. One, cutting that waste is very difficult. Often that waste serves the interests of the people in power and the people spending. And again, we'll talk more about this next week when we cover chapter 21. So sort of pushing back against that is often very difficult. But second, the amount of waste is tiny in comparison to the amount of stuff we actually spend on. If you're concerned about government spending too much and that burden of the deficit and the debt, there's only one way to solve that problem, in fact, and that's to reduce spending. We have to find a way to reduce spending on one or more of those top four items. And in particular, Defense is certainly one, but the others are what we call "quote unquote" entitlements, right? They are various forms of transfer programs from government. And the fact is, the only way we're going to get spending deficits and debt under control is if people are willing to live with smaller Social Security, smaller Medicare, smaller Medicaid. That's it. Okay, there's no other option on the table. Even if you cut defense to the bone, not going to get you there. Okay, so again, I think thinking that you can solve this problem by just kind of rooting out waste and so on. And other people say, well, cut foreign aid. Foreign aid is a fraction of a percent of the budget. It's not going to do any good. Okay, you got to tackle the top four. Last point. If we're worried about the size of government, it's important to remember there's things that government does that don't necessarily show up in the sort of expenditures. One example, it's not relevant anymore, but an example of this was the military draft, right? When government drafted people to fight in Vietnam and World War II and other places, the actual expenditures on that were relatively small, but the sort of scope of government power involved was enormous. Okay, and even today there are lots of ways that government regulates people's behavior that don't have to do with, there's not a lot of spending taking place. They don't cost a lot of money in terms of expenditures, but they do affect people's behavior in lots of ways. They do expand government power in lots of ways, and they do matter a lot for sort of the health of the economy. So one thing to keep in mind is, as much as we focus on sort of fiscal policy, deficits, and debt, these other things matter too. So the question when we turn to look at the chapter on fiscal policy in 18 is, okay, how does government try to use spending and taxation to affect aggregate demand, right? To affect the total level of spending. What's the theory behind why running deficits might be good for the economy at certain times? And if it is, why is it that we have them every single year? It's not that the economy is always in a recession, is it? So answering these kind of questions we'll tackle as we look at chapter 18 in a couple of weeks.